On the show, Texas Real Estate Radio Network. We're talking about real estate investing in the fine state of Texas.
Yes, very good. So we have done very well. We are super grateful to everyone and every possible company that has helped us along the way. Mm-hmm. There's one regret we have.
We just have one regret.
Just one regret.
Okay. I only have like 2 or 3 in my life. Be completely honest.
We have one regret.
But one regret in our business life.
In our business life.
And are you gonna open the kimono, or should we let this go like the second segment? Like have people still listen? They're going, oh, what is it? What do they regret?
Yeah. We don't want to regret. Yeah,
I don't think you want to tell them.
One major regret is investors.
One major regret.
Yes.
I will tell you this. So bought a house maybe 18 months ago. Mm-hmm. And appraised at 165. We are currently under contract at 180. Nice. It was on the market 6 days.
Wow, nice.
And this is a neighborhood. You walk in, and you're like, "This is a $180,000 house." And what you don't realize is the market's moving so fast underneath your feet, you don't see it.
Yeah, it's a big time thing.
So the appraisal from 165 to 180 went up $15,000 in a year.
We are starting to lose some deals in Corpus. Mm-hmm. On price. And I'm like, well, we're not going to have that problem anymore.
Oh.
What's the ask? Give it to them.
Really?
Yeah.
So a couple of our investor buddies kind of figured out that.
Figured it out.
Of course, we've only been in Corpus Christi for 2 years, right? 3 years. So welcome to the party, guys.
Yeah. Even before I met you, I've been exploring Corpus, right?
I told Tom that if Matt Downs didn't join our mastermind, we were going to start a Corpus Christi house buyers down there. Because it's only like 3 hours from Sugar Land, so we could go run appointments down there. I said, we ought to do it. It was a market we identified. How long's Matt? 4 or 5 years? I don't know how long I've known Matt. But it's 16, 17 was when he joined.
Sure. Yeah.
So we've been talking about it since 16 or 17. So it's a phenomenal market.
Still very, very good. But now we get some eyes to it now, right? Mm-hmm. So, we know where our pricing guide is. I'm not going to share that here, but we know what our pricing guide is and what we think per door and how the setup is. Is it a side-by-side duplex? Or is it a single family with a garage apartment? You know, we're going to run those numbers a little bit differently. And if they come within anywhere within 10%, just give them the list price.
Yeah, just give it to them. Doesn't matter.
Write it up. There's the list. We're just, boom. Doesn't matter. We understand the next 5 years.
So here's what's crazy, just to bring case in point from this house that we bought last year. I think I'm all into it for 120, 130. Mm-hmm. It appraised at 165, and about a year later, it appraises at 180. So when folks are running around with their hands in their pockets or putting their hands in their eyes going, oh my God, there's no deals out there. Right. I shouldn't buy. I'm like, that house legitimately made $1,200 a month in appreciation.
Yep.
So for all of you out there that are waiting for the real estate crash and all, it's not happening.
No.
I found a bunch of news, just came out today, forbearances are down for the 3rd week in a row. Like there's no foreclosure market.
Didn't happen.
I was arguing with this guy in Jersey. And he was like, well, maybe that's because I told him, I said, we're down to like 1.9 months of inventory in Texas. We need to get to 10 months of inventory before there's a price correction.
Adjusted, on the price. Yeah.
And he was like, well, I mean, maybe not all markets. I pulled up the entire state of New Jersey. They have like 2.1 months of inventory.
Oh, New Jersey's going crazy. I just made a fortune up there.
Yeah, I was like, what are you talking about?
Yeah.
Do you not know your own market?
He doesn't know
his own market.
No, they don't.
Most don't. That's true.
They believe the guru, not the market.
That's
not
true.
The data, right?
Well, so here's the problem, right? They believe the real estate guru because the real estate guru's got to sell you a course.
Yes, of course.
But the real estate guru's not in the market, so they don't know the market.
They don't? No. You know who knows the market? The hard money guys know the market.
Hard money guys do.
That's
the guys like us.
That's usually our source when you enter a new market.
Yeah.
Who's doing hard money? Tell me where the flip's happening. Yeah, where's the buy and hold happening? Yep.
And the easy way to do that, you don't have to talk to them. Just find out what their rates and terms are. Because if you start seeing stuff below 3 points and below 10%, it's a hyper-competitive market for investors.
New Jersey is basically 2 and 10.
Yeah, that's like...
So guess what? It's a hyper-competitive.
And at 2 and 10, they're not exactly pulling out the Lambos for every day.
It used to be 4 and 13
when
I first started investing there 6-7 years ago.
Yeah, that's private plane money there, but not in... I mean, at 2 and 10 is like, yeah, we're doing okay, but
people will go 1 and 9 too. You get as low as 1 and 9 out there.
Yeah, 1 and 9 is I can only have one Lambo.
Philly markets 2 and 10, 2 and 9.
Crazy.
Yeah, it's a very competitive market for sure. Yep, which tells you what's our hard money at here.
Yeah,
4-12?
Yeah.
3-12?
3-12 is pretty standard.
Are we super competitive?
I don't think so.
No, we're not.
And by super competitive, I mean that the lenders are battling it out with each other.
Yes.
So
Because there's just not enough deals to push money through.
that's right.
So
There's
at,
more
at
capital
3
than
and
money.
12, there are plenty of deals left here.
That's right. Nobody's starving here.
Right. And that's anyway. Someday, most people will get it.
Well, by then we'll be pretty much done with real estate. There'll be a lot of free and clear real estate.
Yep.
It's getting there already. It's like my tolerance. If I don't have I never had a high tolerance for nonsense on social media, especially when folks wanted to argue with me with regards to data and what's really going on out there. But I'm at like an all-time low for arguing over nonsense. It's like, hey, why should we join your group? I'm like, you shouldn't. You need to go spend $20,000 with a backpack and someone claps at the room and you cheer and sing.
You attract all the tartars, man. All of them are coming to you.
Yeah.
I look at some of the things you post, like you tag me and stuff, and I'm like, oh no.
Oh yeah.
And I'm looking at this guy, I'm like, what is going on in this thing?
Yeah, I'm tagging you in some of this stuff because I know you don't see it, and so I'm like, oh, Rob's got to see this. Did you see that fourplex thing? I tagged you in that.
No.
You ought to go back and look. Like last 24, 48 hours. So someone's doing kind of what we're talking about, and I really like the design, so I tagged you in it.
Oh, nice.
They're only doing like 2 or 3, so it's not.
We want to do like 200.
Yeah. So, anyways, it was pretty funny as I'm gallivanting across Facebook and just tagging Rob as quickly as possible in the most controversial posts.
I see some. I follow you, so I see it come up, and I'm like, what is he? Why is he in that group? What is going on there? Anyway, I am. I don't have a lot of time for social media. I do, but I don't. I'm not interested. I'm. The only reason I'm on social media is to manipulate it to get more people to give us deals and money.
Oh yeah, that's totally
Period, right. I mean, that's it.
If folks notice, I mean, I think about 50% of my posts are, here's a class, here's this, sign up for that. Nobody seems to mind. Heck, I posted this one, I don't know, less than an hour ago. It's already got a dozen or so likes, and there's probably 10 comments on here already in an hour. And it's like, it just shows up in their feeds, shows up in mine. It's, I was chatting with somebody yesterday. I was on the bike ride, and we were talking about social media, and he's like, hey, does Rob ever like get after you about some of the stuff you post? I said, no, because he figured out a long time ago that controversial stuff puts eyeballs on content.
Yeah, it's all following. It's likes.
Yeah,
it's people. It's attention.
That's exactly what it is.
That's what we do. Marketing is about attention.
Well, and what a lot of folks don't understand is I can't deal with it's love and hate. They either love you or they hate you.
Yeah.
I either want one or the other. I don't want anything in between, right? What people don't understand is that they think that the opposite of love is hate. That's not true. The opposite of love and hate is indifference. So if you're a marketing person or you're a business person and they're indifferent to your business, you don't really have a good marketing plan.
Yeah.
You don't really have a good marketing strategy.
Let me give you a 20-second expand that and how true that is. People that hate you, you don't care about. People that you want their attention and they don't give you their attention, that's the people that drive you crazy. Mm-hmm. It's the indifference. It's the lack of attention. It's a child.
Well, if we could go into the real deep psychology here, because this is one of the things I've been studying for the last year. It's the power in indifference, right?
Oh,
so
super powerful.
And part of that is just because we don't have time.
Yeah.
I don't have time to respond to all the nonsense. I got other stuff going on. But you, as a brand manager, as a business owner, the real power is we traffic in attention. It's not money. It's not clicks. It's not likes. It's not any other crap. It's trafficking in attention in the people you want to do business with.
Absolutely. Hey, guys, stay tuned. When we come back, we're going to talk about our one regret here in the last 3 years. This is Robert and Jason. We'll be back.
Welcome back, Jason Bible, Robert Orfino, Texas Real Estate Radio Network. To go back to the what did you make last year? It's and it's not to be arrogant. It's like, if you're giving me all this great marketing and business advice, I mean, surely you utilize those same tools and made a bunch of money for yourself, right?
I'm a big fan of Kent Clothier back in the day, and even now he's a good guy. His one big thing he says on every stage is stop taking advice from broke ass people.
Yeah,
just stop it. We got a little thing going on in the office that I'm going to put a little stomp on. We have we don't have constant meetings in this. We meet on Tuesday, we meet on Wednesday, and we meet once a month as a full team.
Yeah.
But we've got a lot, and I can't describe it any other way than poor people talk.
Oh, yeah.
So we got to really step on that come the 1st of March.
One of my favorite things, it's on the quote. If you guys go to there, I have a quote section on Facebook, and they're all great. But one of my favorite quotes actually came from Dan Bilzerian, where he said, "Don't take advice from anybody that makes less than $5 million a year."
Yeah.
And I'm like, he's right.
Probably. Yep.
He's right. So now, if you look at who makes $5 million a year, I mean that's the upper. I mean
It's a lot.
0.00001%, right? So
working on it.
But anyway, so I thought that was fascinating. But yeah, the one regret we've got.
The one regret. So we do have a regret. This is the poor people talk. We have one regret. And when I look back at all the real estate we did.
Yeah.
Let me do the number.
Oh, look, she just responded. She said, "I'm watching the radio show, and you guys just mentioned my fourplexes."
Oh, very good.
So it should show up in your...
Thank you.
What's that, Camilla? Yeah, that's funny. So she's watching the show. That's why I tagged you in it, because I'm like...
Where is she from?
I don't know. Hey, Camilla, where are you at?
Camilla, just come to the building. Let's have a conversation, because
we're
about to raise a whole bunch of money for that.
Let me see where she's at. Hold on one second.
Here's what I'm tired of.
She's in Houston?
Yeah. I got to really have a conversation with the contractors we're using.
Yeah.
Because it's just nonsense. It's just like, we'll make so much more money if we just pool our resources than to keep doing all this sub and full contractor nonsense. So, there's one or two people that need a conversation on this stuff. So, anyway, let me just do it really quick.
What are you doing? Are you doing some math here?
Oh, yeah. Math.
So we sit in our office, even with our staff, and we have a conversation about, well, how many shares did you get? How much money did you make?
Yep.
How many rentals did you buy? Like, my dream company has a bunch of people working there because they like what they do, not because they have to be there. I'd much rather have a bunch of millionaires working for me than I would people who really need the job. And that's what we're doing inside our organization. In fact, one of the speeches you give during the interview process is, if you don't have a couple of rental properties under your belt in your portfolio in 2 or 3 years, I'm going to fire you.
Yeah, you're out.
Because you're not using the knowledge you're getting here, and you're just not going to be a good fit for us.
One, you weren't smart enough to take all the knowledge and the network that runs through this office and get at least one property from it. And why would that tells me that you're not applying knowledge elsewhere.
Oh, that's true. Yeah.
The work that I need you to do, are you not applying the knowledge there?
Yeah.
You got to go.
Yeah, time to go. So our folks in the office are on a strict 2 to 3 year plan. If they're not buying rental properties, they're gone.
Right.
I mean, we're trying to get A-Rock a house. You went looking this weekend, didn't you? Yeah. So
let's go.
How old are you, A-Rock? 21. He's 21, and he's out looking for houses. So it's like, this stuff is not that hard. I know that's the other thing too, is I sent an email out a couple weeks ago. You're so smart, you're screwing this up.
Yeah, people.
It's like, dude, it's just buy the house. Well, Jason, what about this and this and the Federal Reserve and gold and Bitcoin? I'm like, just shut up and buy the house. Right. Shut up and buy that. Oh, because you're too smart. Oh, you're smarter than the marketplace.
Yes. Oh, tons of people.
You're so smart.
Yeah.
Of course, you don't know what fractional reserve lending is, but you're going to sit there and argue about, I don't know, green tech that failed during the freight. And I'm like, you're spending all this brain power on this nonsense.
Right. And that's the thing that's really, I listen to the words, right? And again, they're really smart people in other fields sitting down trying to talk to me about this thing that I do every day. And I'm like, wow, you don't know this. But you're really good over here, so therefore you think that you must be good over here.
Right.
And you're not.
And you're not at all.
And what happens is you start spewing stuff that doesn't make sense or is going to be contrary to your actual real estate goals.
Mm-hmm.
Like, I'm waiting for the crash, or what about inflation, or what about all this stuff? It's like, hey, here's a duplex. Here's a duplex in Galena Park. It's $140, $140,000. Buy it. Right, we're getting $1,000 a side. Why aren't you buying it?
Well, Jason, what about? I mean, is Galena Park good? What about this? What about that?
Yeah,
I'm like,
I heard of Galena Park and flooding and the oil and all. Buy it.
Just buy it. What? Well, Jason, what happens in the oil and gas market and this and that? I'm like, You are not smart enough
Right.
to figure any of that math out.
Right.
In fact, oil companies with
Right.
all their teams of analysts can't figure that out.
Right.
Just go buy the stupid property. I've got it on the board here. I got 3 things I want to talk about at some point, do solo shows on. Real estate crash equals fear. That's really when people start talking, and you actually taught me this. Like when people start talking about all that crap,
Yeah.
I'm like, oh, you're just scared.
They're just afraid.
You're just scared. That's all it is. Anytime that I've got friction in relationships and in, working with folks in our mastermind and just any of that stuff, what my mind immediately goes to now is you're just scared. That's okay, but you're just scared.
And then here's the thing. Even within our mastermind, unless someone tells me to correct them, I normally don't.
Yeah, I don't.
I just smile like,
whatever.
Okay, yeah, well, that's good. You should look that up. That's great. Right? If someone does tell me to correct them, then I correct them.
Yeah.
I'm like, that's tartar work you're talking about right there.
Yeah.
It has nothing to do with anything.
Yeah, what is that?
Anyway, our biggest regret
Biggest regret, Rob?
is our best guess right now, Jason, is that you and I each individually have left $265,000 in EXP shares on the table.
That feels good.
Yeah, we lost about $500,000 by not signing up for EXP 2 years ago.
That's a little painful.
It is. Yeah. Plus, the status within that community, we've left a lot on that table, and we have a broker who just came over 8 months ago. She's already made close to $25,000.
She told us today it was like 25 G's in 8 months.
Yep,
just in stocks.
Stocks, right?
Not bad.
I mean, tell me other real estate agents that have a retirement plan that are making that, right?
Yeah.
They're not. On top of being capped, on top of getting her extra shares and more money and all that other stuff, she's doing really, really well. She's going to close about 40 deals in 1 year, right? She's going to make a full commission. She's getting 100% right now, so that's $16,000 that everyone freaks out about. Again, if you're not going to close more than 10 deals, you probably shouldn't come over to EXP. We don't want you, right?
Yeah, we don't. You're not.
And we want someone who's going to move and go. So our big regret is that we did not join EXP.
Yeah.
And so we'll come back into the next segment here, talk about all our live events that we're going to go on, but we're also talking about how you can get into EXP now. I think the fact that more agents are joining drive up that price, just basic economic laws. And people see the inner workings of how well EXP really, really does. I know that my wife is an agent. She's doing great over there. So there'll be some opportunities coming up every month for you guys to sit down with us and figure it out. But we're going to come back from the break here. This is Robert and Jason. This is the Texas Real Estate Radio Network. If you're interested in learning more about EXP, go ahead and text us. Text 281-401-9008. 281-401-9008. And just text EXP, and then we can start that conversation. Thanks. Hey, we'll be back.
Welcome back. Jason Bible, Robert Orfino, Texas Real Estate Radio Network.
So starting in March, we're going to do live events.
Yes.
But we have one coming up now this week on Thursday night.
It's already sold out in like 5 seconds.
Yeah, it's sold out in less than 3 days.
So it's the mastermind preview. This is our mastermind weekend. So a bunch of folks are flying in town. We're gonna be hanging out. It's gonna be a lot of fun.
So I'm telling you what we're gonna start doing for everything that we do. We're gonna put a $10 ticket on it.
Ooh, I like that.
Because here's why. If it's free, people they don't go. It's a 50-50 chance. Like we know the numbers. If we get 100 signups, about 40% are going to show up because it's free. Mm-hmm. If we make it $10 and we get 40 signups, 30 people show up. They don't want to lose their $10.
Yeah.
Right? And I get all kinds of crazy emails about, can I get a refund for my $10? I'm like, no. No
refunds. So
we're at 30 people, and we really only have room for 30 because we're doing the COVID social distancing and all that stuff. And we're sending out an email today that said, if you're not going, delete your ticket.
Yeah.
I've already got 4 people who are emailing me, hey, what's going on? How come I can't sign up? Hey, it says it's sold out. Yes.
Yeah, it's sold out.
It's sold out.
That's what happens.
Yes.
Well, we're back to physical meeting space.
Yes.
And there is a capacity.
And there is a demand to get the heck out of the house
Yeah.
and start networking again. So there is a capacity. Yeah, we have a room that usually takes about 100 people. So we're going to do it about 30. And I got space for people who are in the mastermind. They're going to come and network that night. There'll be about 40 people there. It's going to be a great event. But moving forward in March, it looks like we're going to have about 2 live events every month, and possibly a third. We might do a Saturday morning EXP rally type deal.
Chris wanted to do something. He sent me a note yesterday about St. Arnold's and doing some stuff there, and I'm like, I'm down, dude.
Yeah, we do it right here too. St. Arnold's will deliver.
They do deliver. So,
but we're gonna get. Well, people should. If we're talking about EXP, and if we're just getting together and all patting ourselves on the back and how great EXP is, then we go to St. Arnold's. If people are coming here to learn about how to join EXP and what building they'll be working out of and where the meetings are, then we want to do it here.
Oh yeah, absolutely.
Right. And again, our big regret is EXP. So we're doubling down. We're going to do 2 meetings a month to talk about moving people over. One will be live. One will be a webinar.
And this is for, I'm an agent and I'm an investor. It's how to be an investor agent.
For sure. Yep.
So you guys are going to work with us to start building your own portfolios, represent other investors, work with wholesalers and that sort of thing.
There's brokers that do $20 million of transactions a year and don't have one rental property.
Yeah, which is crazy.
And we have a new vendor coming on, and I don't want to get into that because we're going to give them a full show. But I explained to our broker today why she needs to buy some apartment buildings and what the big number was. And I'll just say this. There are 4 ways to make money in real estate. You can sign the contract.
Yep.
You could buy, fix it, and flip it. You could buy and hold it. There's 5 ways to make money. You can buy and hold it. You can write the notes, trade the notes, sell the notes, create notes. And the 5th way is depreciation.
That's right.
And we're bringing on a new vendor who's going to talk about depreciation, accelerated depreciation, and cost segging and all that stuff. And the numbers are ridiculous.
All right. So maybe you've not heard of how to make money from depreciation. And the reason you don't is because it's something really wealthy folks do.
Yes.
The check I'm going to get back from what we're doing from the IRS is going to be ridiculous.
Yes.
But the problem is you have to be earning a lot of money.
Yes.
You have to have a lot of property. So it's not...
Which is why doctors move into real estate.
It's you just start getting murdered on taxes. You're like, this is ridiculous. How do I solve this problem? And there are assets that get traded just for the depreciation.
Yep.
Between the 1031 exchange and depreciation, they get traded on that basis.
And, as a big building here, Texas Real Estate Investment Center, we should have someone that does that in the building and works on that. So we're also looking for a 1031 facilitator to kind of pick up an office here too. But anyway, we looked at that, and if we can do that, if you can be an EXP agent, you can make stocks, you can go buy your own properties, you can get some accelerated depreciation on those properties to help you pay the tax, because it's all... you got to be pretty clever as an agent, but the problem is with agents, the real estate industry is one of the highest audited industries.
Yes.
So you've got to really have a good CPA that's going to follow the rules. But that whole depreciation, and this really came out of you and I having a conversation with one of our mentors in the business guy is Stephen Hall. He runs Robert Hall and Associates in Glendale, California. Check them out, Robert Hall and Associates. They do all our accounting, and they're good advisors for us. And he said, looking at our books, Robert, it's time to go buy apartments and do the accelerated depreciation, because you're going to start getting hit with big tax numbers.
He's like, you guys need to be buying buildings like it's going out of style.
Yeah, I said,
just for the depreciation.
And he doesn's. He's like, I don't care what it is, man. You can buy an ice skating rink. I don't care what it is. I just need the depreciation.
Yeah.
So. This whole crash about office buildings and stuff like that. People need to trade that stuff, right?
Yeah.
People will buy it, and if you get it cheap, if you get that your insurance carrier lending at 3.5%, and your accelerated depreciation is 25%, then you wonder why you drive around town, you see empty office buildings. It's like, no, they're not making any money. It's like, nope, they're making a ton of money.
No, they're just not offset with other stuff.
Yeah, I think offset.
That's why we build portfolios and not single assets.
Exactly.
You put it together a portfolio. That's the important piece.
So that's big time stuff that rolls right into EXP. All those agents need to start getting some assets. You can do this on single families too. You just have to have a portfolio. Mm-hmm. So we're very excited about that. But if we could do it all over again, we would have definitely started with EXP. We would have we'd have been icon agents. We would have done everything we were supposed to do. We would have, an extra $250,000 in stocks each.
It's not bad.
No, it's not bad. And are the agents working for us would have made more money. That's the biggest thing. We've gone through agents because we were with other organizations, and the numbers just didn't work out as well.
When you look at the profit share and rev share models, it's hard to, and that's the other thing we experienced with some other folks. It was like there just wasn't enough to get it going, right? Yep. Especially when you start looking at profit share, because it's like, well, if you write everything off against the brokerage, it's like, so then that office doesn't really make a profit, right? And so it's so anyways, the rev share model with EXP makes a lot more sense.
Yep, it sure does. It's revenue share, not profit share. It's off the top, not off the bottom. And in that world, then you don't have to worry about splits and all that other stuff. It just automatically works. So yeah, we probably should have kept 3 or 4 agents. We would have liked to kept them around, but they had to go on and do their thing. If we had done EXP, we'd have a little bigger. We'd probably have more properties, more money, all that stuff. So it leads to it. It's not just the fact that we didn't join EXP. It's the fact that we missed all those connections through EXP, which probably would have took our portfolio from the 30 million to 50 million.
Yeah.
So there is a great missed opportunity there. We don't want you to miss that. We want you to come, join EXP, look for our webinars, come to the main events. We're going to have some fun here. We got about 30 seconds left. Thank you all again. So we have a live event Thursday. That's for the mastermind. Now, if you're actually interested in joining the mastermind, then email me, right? Or just text me at 281-401-9008, and I'll put you on the wait list. When people drop, we'll get you in there, 281-401-9008.
And mastermind price goes up by $2,500 in April.
Yes, it's going to go up in April.
So if you want to join, it's $10,000 now. It'll be $12,500 April 1st.
Absolutely. We told people that we're sticking to our word.
Yeah.
Because we're seeing people already making, $50,000, $60,000 in 1 year with us. So it's, come on, guys. So go ahead and text us at 281-401-9008, and I'll get you on the wait list. As Robert and Jason, Mr. Texas Real Estate, we'll be back.
So this weekend's theme with the mastermind folks, at least for me, is we're going to be talking a lot about inflation.
Yep.
And if you are someone who is into long-term fixed notes, or you're into, or you've just got a lot of cash sitting on the sidelines, you are about to get absolutely hammered.
Yeah.
So get ready, guys.
We're going to do that on Friday afternoon. You got 60 minutes.
Yeah. So I'm going to talk for an hour about what's going to happen in this economy next. And if your personal net worth is not exposed to equity in real estate, you're going to miss out. So equity is the name of the game. In fact, I just saw another article it just came across. I mean, in some cases, you're talking about 15, 20% a year appreciation. That piece of junk I bought over a year ago, over 15% a year in appreciation. So appreciation and inflation. So if you're sitting on the sidelines trying to wait for the next great deal, like this is literally going to pass you by so fast, you're going to be stuck with the same 100, 200, maybe a mil or two that you wanted to invest in real estate that is now worth less because you waited. It's the waiting that's going to kill you. So just get into a deal, get into a syndication, get into our fund's a great example. Get into the fund and expose that investment to equity. Like we do on our fund, it's like a 9% preferred return, right? We pay it quarterly, pay 9%. Pay 9%. And then we've got an equity kicker of 10%. So anytime we sell a property, 10% of the equity goes back to the investors. Yep. So it's like, well, why wouldn't you do that, right? I'm actually working on that whole article right now. Your returns are lying or something like that. I'm trying to remember what I named it. So that email is probably going to go out tomorrow. But yeah, the reality is that you are going to gut yourself if you are not exposed to inflation-adjusted assets like real estate. In fact, real estate is really real estate, healthcare, college, university. I mean, I don't know how you invest in. I guess you could. University of Phoenix, I think, is publicly traded. But anyway, so you, at the end of the day, what are you exposing your personal net worth to that's going to track inflation? And And if you're not doing that, it's not. And I'll tell you right now, all the traditional metrics for tracking inflation from the federal government are not right.
No.
We know they're not right. And the question is why? Because if they did, then they'd have to change a lot of the rules around Social Security. That's really what the trick is with inflation.
Sure. And all the, yes, absolutely.
That's why they went from inflation, they went from using the CPI to the cost of living index. So, because they don't want to, they can't pay retirees what they really need to be paid based off the cost of living increases for the last 20 years. So what does that mean? That means every single one of the dollars that's sitting in a checking account somewhere, every single dollar that you're receiving, you've got to reinvest as fast as humanly possible.
Right. Which is why people will take less. They're not waiting for the 12% note anymore. Now we're at 8. We're at 8. The market's 8% for notes.
Right.
Right. So now they're pushing at 8. And if you have a note, you're like, oh, Brian's got notes. You're gonna talk about it tomorrow on the radio show, right? We just created, I think, 4 more, right?
Yeah.
So those would go like that. Mm-hmm. They'll go like that. There's equity in the properties. They're cash flowing. The DSCR's numbers look great. What are you waiting on?
Here's my prediction for the note business. Over the next 24 months, this is what's going to happen. The small guys that have their IRAs with $200,000, maybe $1 million in them, they can buy 4, 5, 6 notes right now at 7, 8, 9%.
Yep.
But when I had Sean in here last week, he said, Jason, we're seeing some 15-year stuff trade in the ones.
Right.
So there's so much money that got printed in the last year that these big non-QM lenders are just going to say, we will do every deal at 3, 4, 5%.
Yep.
And that's going to push down the rates of return for the individual investor.
It's already happening.
It's absolutely already happening.
Because you've got Wall Street funds reaching out to people like us.
Yes.
Like, hey, we'll give you, now it's 7.19.
It's just crazy.
Yeah, they'll buy the notes at 7.19.
Yeah.
But it's got to be underwritten in a certain way,
right?
So it's easier to just
But I think
the individual was, but we'll get that underwriting straightened out, and then everything now with a competitive number of 7%, right?
Well, he said, man, we got a DSCR only product where you just got to show that DSCR is above 1.25, you got a decent credit score, and you got some cash in the bank, and they'll do the loan. They don't want tax returns, they don't want anything else. And I'm like, and I said, what rates? He's like 5, maybe 6. So what's going to happen as more money enters the marketplace? Like this whole idea that I'm going to get 7, 8, 9, 10% on my notes, that's going to be gone in 2 years.
Right.
Because there's too much money out there.
We just did a refi for one of the mastermind students. They just did their thing. 5.25.
That's great.
Yep. 30-year amortization.
Great.
5-year note on a rental.
Probably
property.
didn't even buy it down. Probably could have bought it down another
He
point.
could have.
Right?
Yeah. Probably could have took it under 4.
Yeah.
On a rental property.
On a rental property, which is bananas.
Yep.
Absolutely bananas. So this whole idea that everyone keeps thinking rates are going to go up. They ain't going anywhere,
Not
dude.
for a while. Nope.
I don't even think in our lifetime.
Still another $1 trillion coming into the marketplace. And they're going to do another stimulus round, right?
Yeah. Where do you think that money goes? Do you think another? Let's get real honest.
Where does that money go?
Let's say $1 trillion. It's going to hit a bank somewhere.
It's going to hit.
Hits the banking system, right?
It's going to go to the banking system.
So, do you think if another $1 trillion enters the marketplace, that rates are going up or they're going down?
Right.
I could tell you they ain't going up.
Right.
They're going down.
Which is what people don't understand. When all this money went to, again, I think we printed $3 trillion so far, $4 trillion, something like that.
I think when you add up all of the stuff that's happened, it's almost $20 trillion.
Yeah, but that's going back to Obama and stuff.
No. That's with all this coronavirus stuff.
Really?
Because you've got to think it's
So
all.
how much did people actually get of that? Less than $1 trillion.
Oh, it was nothing.
So where'd the
it was
other
200
19
billion.
go? It went to Goldman Sachs and Wells Fargo and Bank of America, and it went to Morgan Stanley. It went to commercial guys that can push money into the marketplace.
Okay, so you're making a really good point. This is a point we've got to hone in on. So you could print a lot of money, but there's only so many places that can use it.
Right, and the problem giving you money is that the federal government doesn't know what you're going to do with it. You could wind up paying off debt, which we don't want.
We don't want paid off debt.
We want you to go buy more big TVs.
That's right.
Right, and that's a big problem. So we know we have tenants that took their $2,000 and didn't pay the rent. They went and bought new shoes and new clothes and new TVs so they want that money going out into that marketplace. We know that if we give Goldman Sachs $800 billion, that they will find a home for it.
Yeah.
They will push it out into the marketplace where they want it to go.
One of the craziest things that happened is when the Federal Reserve hired BlackRock to buy junk bonds.
Yes.
Which I don't even think is legal. Like they have to get congressional approval to that. But then they were also BlackRock was buying its own junk bonds while they were crashing for the first couple of months in Corona.
Sure.
Like there's a lot of these financial stories that don't make it out into the public because they're too complicated to explain. But what you guys are not seeing is basically the guys that can deploy hundreds of millions and billions of dollars.
Yes.
Those are the people that are going to get the money.
Of course.
Because they can put it to use.
They can put it to use, right. They can lend it to more companies, and the companies can stay afloat, right? And they can keep their employees, they can keep the lights on, and it's an easier way to get it out into the economy than giving it to A-Rock, and we don't know what the heck he's going to do with it.
Buy a Lambo.
Yeah.
A-Rock's getting a Lambo.
Right. Get a house, right.
60% of publicly traded companies have a negative net worth.
Right.
40% of them can't service their debt without new debt. So where do you think all this money? You think rates are going up? Rates ain't going anywhere. Come on.
I think what most people don't understand is the difference between GAAP accounting,
oh yeah,
right,
yeah.
and the net worth of a company. Because
that's true.
Isn't counted in that. You can make a profit and still have $20 billion worth of debt.
Well, sure. It's just like your
right?
household. Like I made $200,000 last year, right? But I'm a negative net worth because I got $500,000 in debt. You're actually worth less. You're only worth negative $300,000.
Right.
Like my 9-year-old and my 13-year-old have a higher net worth.
Of course they do.
Than 40%, actually 60% of companies out there.
All right, guys. Thanks for joining us tonight. We appreciate you always. Robert and Jason signing off.